This is Company Breakdowns from Turpentine, a deep dive on a compelling tech company's strengths, TAM, business model, and potential for market domination. I'm your host, Erik Torenberg, and on this season, I'll be joined by the smartest people in tech to record 1-hour deep dives on companies like Reddit, Databricks, and more. Today's episode is with Alex Clayton of Meritech Capital, and we'll be discussing Klaviyo.
Alex, welcome to Company Breakdowns. You're the king of S1 breakdowns, so I'm honored to have you on.
Thank you for having me, Erik. It's good to see you.
Yeah, likewise. Excited to get into Klaviyo this week. You wrote this breakdown late last year, but thought it could be a good time to get into it. Why don't you first give your sort of brief perspective before you wrote the piece? How would you perceive the company? What was your sort of history, sort of thinking about it? Why don't you give some background, and then we'll get into the company itself.
Yeah, for sure. So Klaviyo, by the way, it's quite a remarkable company. I think there's very few businesses that have done what they've done. I know up until their IPO, they raised about $500 million, and to get to almost $700 million of ARR, they burned $15 million. That's the implied burn figure. We don't know the exact figure, but that's how we benchmark companies, which is pretty astounding, honestly. And so, firstly, just congrats to the business. It's truly unbelievable what they've done. The company is a marketing automation solution primarily for B2C businesses in the Shopify ecosystem. And so they got their start really helping Shopify merchants better to send better messages to their customers across channel, whether that be email, which is the channel they got started on, SMS, push, etc. So it's really an omni-channel marketing platform, mostly in the Shopify ecosystem, although they're broadening out from that. And so it's interesting. I've spent a lot of time in the marketing automation space. I was an investor in Braze, and then also looked at Klaviyo's first larger institutional round. And it was a bootstrap for a while. And again, credit to Andrew, the CEO, as well as the team there for building a business with an extraordinarily low amount of capital, and building a company that, there's not many CEOs who choose to and have the ability to have such a great product with such an efficient acquisition strategy in such a unique market where they can burn so little money to get to such a large business. And, there'll be $1 billion of ARR in the not too distant future and never really burned any money, which is pretty unusual for a software business. So it's a very fascinating space. I mean, it's been, if you think about the market, Adobe, you think about you have to bifurcate it B2B versus B2C. Market automation, if you think of like Marketo in the B2B world, was sort of the incumbent. On the B2C world, it's really all over the map. You've got Adobe with their marketing cloud at the very high end, Salesforce Marketing Cloud, SMB mid-market HubSpot, and then SMB, you've got MailChimp, which was acquired, but they were over $1 billion of revenue. Klaviyo is there got their start in the SMB, and then they are moving up market a bit. And then Braze, which is one of the full disclosure, that I was an investor in, and Meritech does not currently, we are fully distributed out of that position. But that business is about $500 million of ARR and growing incredibly quickly. That's more mid-market enterprise. So Klaviyo might bump up again them on the very low end of the market. Although Klaviyo got its start in really the Shopify ecosystem, which, average companies pays them about $5,000 a year or so, very, very different than Braze. So it's a massive market, although it's extraordinarily competitive. And so I think, but Klaviyo, besides HubSpot, is really the only, only company in the space that's gotten public in that SMB mid-market market automation space recently.
And let me start by asking the naive questions, which is, if they were built in the Shopify ecosystem, why didn't Shopify build this, or why didn't some of the other competitors who go down market?
Yeah, it's a really good question. So Shopify is an investor. They own about 10% of the company. They put a lot of money in Klaviyo. And I think it's always this interesting dynamic, and it's particularly relevant with some of the companies that I work with, where you have to decide, do we compete or do we create an ecosystem around us? And on one side of the coin, you could say, if you're Shopify, if Shopify merchants are reaching their customers in a more efficient way using Klaviyo, they're going to be doing better and stay on Shopify and pay us more money over time, because Shopify's business model is taking a rake on the transaction. You could make that argument. And then you could also say, if you're Shopify, we do better if companies build an ecosystem around our customers to make our customers better. And Klaviyo being the dominant player in the marketing automation space for Shopify merchants. And Shopify is also an investor. And so Shopify is sort of winning in all ways here, I think. But I think the fact remains, Klaviyo has an incredible product. It has a lot of surface area. It has a lot of depth. That's not Shopify's core competency. Shopify is an incredible business with very smart people, but I think building what Andrew and Klaviyo have built would be really tough and would take them a while. And so it doesn't surprise me that they decided to partner, invest, and really push Klaviyo in their ecosystem.
And talk about Braze. Talk about the company you invested in terms of, is it the same product but a different customer segment, or maybe let's get into what makes the Klaviyo product so differentiated.
Yeah, for sure. So Klaviyo got their start on the very not low end, but just small side of the market. And if you think about a world where we're going with less cookies, where tracking people across the internet is becoming more challenging, first party data is really important. And so Klaviyo has really the best product for Shopify merchants and SMB B2C companies to do that. Particularly, I mean, I think it's like 95% of over 90% of their business was in e-com. It was around there. So it's mainly e-com. I need to confirm that, but that's around there. And so Braze is, think of, they do similar things, but very different customer base. And so I think, Braze, if you're going to show up to Gap, and Gap has, hundreds, if not thousands of retail stores around the world. They have all these systems, all these types of transactions happen in retail that happen in their stores. They want to create a single view of their end customer. That's what Braze enables you to do, because the company was built with an architecture that gives the marketing teams of very large B2C organizations a 360-degree view of the customer. And that's something that Salesforce's Marketing Cloud cannot do. Salesforce Marketing Cloud is essentially ExactTarget, which is a multi-billion-dollar ARR business, but it was built for the email world. It was not built for mobile. It was not built for push. It was not built for omni-channel. Irrespective of channel, Braze can market to you. And think of them as like the marketing spaceship for a large B2C brand. Quite an amazing business. They got their start in mobile marketing automation. That market was super competitive. A lot of the businesses there, unfortunately, didn't even make it. And Braze in 2016, 2017 made the decision to go omni-channel and allow their software to market across channels, predominantly in email. That broadened out their suite. It's an amazing team. I think it's one of the, if not the smartest team in marketing technology, and they're doing exceptionally well. They're around 500 million ARR business, growing quickly, improving margins, and what is objectively one of the largest software markets in the world with a modern product. And so they compete in a little bit of a different segment than Klaviyo. It's much upper end, where Klaviyo is a lot of PLG, a lot of smaller Shopify e-com merchants. And an interesting comment that I was going to talk about, when I was doing diligence on Klaviyo, I was talking to one of their customers, and the product was so powerful that this customer told me, he goes, I was watching the Super Bowl on Sunday on my couch with people over having a beer, and I orchestrated an entire marketing campaign while I was watching the Super Bowl, and it increased my orders dramatically. And it was sort of like, that was a super cool anecdote where what Andrew and team have built is a super unique, very broad, but yet easy to use marketing automation platform, where Braze, if you're the CMO of Gap, no one would be giving you the wheel to be sending marketing campaigns on your couch watching the Super Bowl with friends over. And so again, very different customer segment, different product, but Klaviyo is really built for that, sort of single player to go in, build their own campaigns, and run them across channels.
Right. And you mentioned you were looking at them early. A lot of people presumably looked at them early and didn't end up pursuing it. What do you think people missed about the business?
Yeah.
that seems maybe obvious in hindsight, but at the time, it was a big
Yeah, I
challenge.
mean, I think it's almost a $7 billion company. They are below their issue price. They did raise, I think, close to 10 billion, and they're below that today. Although, obviously the multiples and the market has changed. The business is performing exceptionally well. What do people miss? I think, and Bill and John and Miles at Braze, I think, share these characteristics as well. Like Andrew is just an incredibly smart CEO. And I think people were worried when that round happened. By the way, that was a very competitive round. I mean, obviously, the private markets are an auction. And so there's one winner. That does not mean that many other people, including myself, were trying to get into the round. Summit Partners ended up doing that transaction. I believe that was, as I mentioned, the first large institutional round the company had done. And the concerns about the business are probably some of the same concerns people have today. You are really tethered to Shopify and to e-com. And how do you broaden out from those areas? Like, how do you get into retail? How do you get into other industries? I think HubSpot has done that incredibly well. HubSpot's about a 2.3 billion ARR business today. They're multi-product across verticals. They also trade at a much higher multiple than Klaviyo does. I think the street is going to want to see new products, new verticals, new segments for Klaviyo. They did launch a text product that has been getting a lot of good uptake. But less than 5% of Klaviyo's revenue at IPO was outside of their core retail e-com vertical. And think about when they were smaller. I mean, that was it. It was like, I can't remember exactly. I'm sure it was like 99%. So I think that's what people got wrong. With that said, the depth of that market is huge. Klaviyo is going to be a $1 billion ARR business in the not too distant future, basically just focusing on e-com, smaller e-com merchants. And so you think about how big that market opportunity is.
We'll get back to the conversation in a moment after a word from our sponsors. The tech world turns to the Brave browser for its unbeatable privacy protections. But did you know that Brave also has a private ad platform? Brave Ads offers first-party targeting, and it's been cookieless since day one, so you can relax while third-party tracking cookies disappear from the web. Today, millions of people turn to ad blockers to avoid being tracked and pestered online. But Brave's new ad model aligns incentives for users and advertisers. Users earn rewards for viewing ads, which they can save, spend, or pass along to their favorite creators. And advertisers score points for respecting user privacy, generating ROI without invasive tracking. So whether it's high-impact announcements on the new tab page or keyword-targeted ads in Brave Search offers diverse, private, future-proof ad formats for all your business goals. Join the future of advertising at brave.com/ads. Mention Turpentine to get 25% off your first campaign.
TAM is not their question, but I think at the point in time when they were raising, TAM was a question because it was unclear. I think this is 5-6 years ago. Could you build a big business in that segment? It's very clear today that you can.
It's not a question to building a big business, but one question I have is how big of a business can this get? Like, how big can they get? Just doing what they're doing today, and then sort of what are the adjacencies that? Yeah, what are your thoughts if you were evaluating investment at this price?
Yeah, I think no investment advice here. I'm not a shareholder of Klaviyo, but I think a couple things. I think there are signs of a couple things that were really working for the business, moving up market. And so they disclose companies that spend over 50K with them annually. At IPO, that was growing almost 100% a year. And if you kind of do some interpolation around the math, they don't disclose exactly, but you could tell that was a pretty big business. Like it was at least 75 million of implied ARR growing 100%. And so that part of their business is growing very quickly. And I think believing in that upmarket story is something that gets me personally excited. I know they hired a new CRO from Okta last year as well to run the go-to-market organization. So clearly with Steve Rowland's background, they're focused on moving further upmarket. That's got to be a big initiative for them. So I think that alone, like again, back to the market size, Adobe, the big marketing clouds in Oracle, Adobe and Salesforce are probably combined anywhere 5, 7, 8 billion of ARR. those are very legacy products. They do have a tight grip on their customers. Braze is fighting that same battle and doing very well. But those are also, big companies. So I think, being able to pull that away slowly is definitely Klaviyo's goal. I think they can probably do it. So I think upmarket makes the most sense for them. I'm sure they are expanding outside of verticals. I just think that's probably going to be a longer cycle there.
Yeah, that's really interesting. I want to go back to something you said earlier, which is how they've only spent $15 million and how they've been able to make so much money with such little spend. Talk about how they've been able to do that and why it's so rare. Like, what have they figured out that other businesses haven't figured
out? So I think, they really nailed the PLG motion for this vertical, and they had distribution. And I think that's one thing that is a great case study for Klaviyo. They went and said, Andrew said, we are going to go win this vertical. We are going to win the Shopify ecosystem, and we're going to win e-com. And they were really focused there. And they started with email. And if you think about e-com, it's all email. I mean, that's still the most dominant channel of how you reach consumers. And they have other products and push and SMS now too. But it was sort of like a great case study in focus. And I think a lot of companies can take away from what Andrew decided to do there, where you could say, oh, that's a really small market. And how are you going to build a big business in SMB e-com with basically getting distribution through what could be your biggest competitor at some point? So you could call that a risky strategy, but at the same time, you could say that's actually a very good strategy because he won the market and is winning the market, and Klaviyo is winning the market. So I think that's what enabled them to be so hyper efficient. And if you hear Andrew, the way he talks about the business, it's very first principles. I want to build a business. He wanted to build a business that made money. And if you want to build a business that makes money, you've got to figure out a way to be profitable. And we're not talking just free cash flow positivity. We're talking GAAP profitability, companies that actually make money. And because they figured out this flywheel through the Shopify ecosystem, their paybacks were unbelievable. They weren't just boiling the ocean and spending a bunch of money on trying to grab every customer that maybe could use their product. They were very focused. And so I think it's a DNA of the business that really enabled them to do that, plus the singular focus on one end market. It's almost like, in some ways, they have the margin structure of like a highly successful vertical software company that really cleaned up their end market, like a Viva. But it's actually a horizontal solution just focused on one vertical. And now they're expanding out. So I think it's rare that you see companies, because you think about the software model, the cost of acquisition happens up front and customers pay you ratably over time. And so it's very hard to be free cash flow positive at the start and grow quickly, because the unit economics of the software model don't allow for that, unlike it did in perpetual, where you'd get all the cash up front, selling a license, and then you get in the maintenance stream. So it just goes to show how uniquely incredible it was of what Klaviyo did, and the product market fit was just extraordinary, and frankly is extraordinary for that segment.
You mentioned not just free cash flow positivity, but GAAP profitability. Can you unpack that for listeners who may not be familiar with the difference as we're learning how to break down companies more broadly on this podcast?
For sure. So I won't go into like the deep accounting around this, but essentially, if you sell $1, or let's maybe use something a bit different. If I sell you a contract for the whole year, and I'm going to say, hey, Erik, I'm going to pay you. You're going to pay me $100 for the software product XYZ that I'm giving you. You give me that $100, but I only recognize the revenue ratably over the term of the contract. Let's say it costs me $100 to find you as a lead and sell you that. Well, okay, you paid me $100, but I paid $100 to acquire you. You'd be like, oh, well, that's great. Well, no, because of revenue recognition, you pay me, or I recognize the revenue essentially each day over the entire year that you're using the contract. And so because of that, you paid me the money annually up front, which a lot of software contracts are, and it's sitting in my deferred revenue balance on on the balance sheet. And then if you think about the free cash flow statement, as that deferred revenue balance grows, I can actually be free cash flow positive, but in my P&L, my profit and loss statement, be losing money on an operating basis. And so the typical journey is for the typical software SaaS company that goes public or matures, you reach free cash flow positivity first, and then you reach profitability on the P&L second. And then there's obviously GAAP versus non-GAAP, which one of the largest components of the delta there is stock-based compensation. And so it's even harder to be GAAP profitable because that includes the cost of stock-based compensation. A lot of times software companies will report a non-GAAP profitability metric on the P&L, which is excluding the cost of stock-based compensation, which we know that's a big part of compensation for startups and software businesses. And so it's a fine metric to look at because it helps standardize the actual operational components of the business. But at the end of the day, at some point, you've got to make money as a software company. And Klaviyo is already doing that at IPO in a GAAP basis, which is super unique. And I think it's maybe a broad comment around the beauty of the software model. Think about it. You pay me $100 a year, and if I'm a company that has on average, say, 125% net dollar retention, that cohort pays me $25 more every single year, sort of into perpetuity. I pay to acquire you up front, and I have this amazing annuity stream. And why do SaaS companies trade at high multiples? Because all investors do is look at the net present value of future cash flows using a DCF. And in a software company that has high margins into perpetuity, you get a very high net present value for the price of your shares today. And that's why people love software companies. That's why private equity loves software. That's why Wall Street loves enterprise software, because it's very sticky. The cohorts grow over time and they can be very profitable. But very rarely do you have a business like Klaviyo, particularly in SMB, which is notorious for having high acquisition costs, be GAAP profitable at IPO, which is, again, credit to Andrew and the team there. That's very, very unique.
And just to further flesh out how unique it is,
Yeah.
Why don't you compare sort of their costs or sort of a percentage of sort of expenses, almost pie chart wise, to how other companies usually, who might be in a similar space or comparables, usually divide up their costs? Like, where are they not spending money where other companies usually spend money?
Yeah, for sure. So maybe we'll just talk about their P&L, which, kind of the last reported quarter in the S1, they were they were net income positive, and they had almost 20% free cash flow margins. So if you just go down, we've obviously got revenue. Their gross margins, pretty high, not best in class, but pretty high. They were at almost 80%. They were at 77%. And so I would say, call that very strong, not incredible. I assume they have a target. They do release a target model as well, where they think they can get up to, they sort of want to get to the mid 70s, because they will have some products that bring margin down. But sales and marketing, they only spent 39% of revenue on sales and marketing. A lot of software companies are spending 60, 70, 100% of revenue in sales and marketing. Klaviyo is spending 40%. Again, super unique. And I think it's part of their focus on retail, Shopify ecosystem, and efficiency. R&D, they were at 21% of revenue, which is, in line with comps. Again, this can kind of sway in multiple directions. And then G&A, they're about 15% of revenue. So the biggest line item there that's different from them to many other software companies is that sales and marketing line. They are, for a unit of growth or a unit of acquisition, they are paying much less. And I think it does go back to them focusing on a single vertical. And that's very reminiscent of successful vertical software companies. They have a much lower sales and marketing as a percent of revenue, because how do you acquire customers? You've got to spend money. So if you just kind of walk down their P&L, if you add up all those components, they were GAAP profitable in a 6-month period, their last 6-month period in their S1.
And will that change once they sort of have to expand with sort of those numbers outside of their core competence? And I guess how much more room to grow is there within that sort of core, either Shopify sort of ecosystem or sort of adjacent?
Yeah, no, there's been a lot of analysis, and so I was reading some research because it's really hard to figure this out. Analysts think that they're anywhere between 25% and 50% penetrated in the Shopify ecosystem. And let's just say, at this point, or at IPO, they were 650-ish of 700 million of ARR. And so that TAM alone could be 2 or 3 billion. It could be 2 billion. And so you think about, I think they have room to run there, but not unlimited. You're right. So you're actually operating in sort of a limited, somewhat limited TAM, where Salesforce Marketing Cloud is doing, I think, 4 or 5 billion of ARR, and they're still a small percentage of their overall TAM. And so e-com, Shopify merchants, not overly huge, few billion, relatively speaking. Marketing outside of that, obviously, sort of unlimited TAM. So that's why they're really pushing on new verticals to open up TAM, as well as moving up market. And so I think there is some limit to probably how fast they can grow. They also had a pricing change that did cause them to grow pretty dramatically that they called out in their S1. They raised pricing, and that artificially inflated revenue growth. I don't think that's not going to be enduring. But if you look at their long-term operating model, their long-term target is to spend 23 to 25% of sales and marketing as a percent of revenue. R&D is going to go down to 18 to 20%, and G&A will get down to 10 to 11%. And so they're going to be a 20% plus non-GAAP operating margin business, and they're shooting for 25% plus free cash flow margins. And so they don't need to grow that quickly to be a Rule of 40 company in what is an incredibly large and underpenetrated market outside of the Shopify e-com ecosystem. And so if you believe that story, I think they've got a lot of room to run. With that said, they are trading at a much lower multiple than HubSpot, and they're also trading below their IPO price. Probably ask, why is that? I think there's a few questions. I think there's some TAM questions that investors had. Multiples are sort of, they were one of the first SaaS IPO, or they were the first SaaS IPO to go out last year. And so, there was definitely some trepidation, although they had a very successful offering. I've heard from some investors on the buy side, there's some float concerns, meaning that, the CEO owns about 40% of the company. And there's also another investor, Summit, owns a very large piece. And so no buy side investor wants to get in if a hedge fund, if an insider is going to go sell 30% of their holdings, the stock will drop. And so there's always this push and pull with new software IPOs where the buy side wants to see what happens when the lockup expires, to see how many people sell before they get in. So I think there's some float questions happening right now, but the performance of the company has been really strong. I have to imagine they can be, can they be the size of HubSpot? 2+ billion of ARR, growing 25% with 25% of free cash flow margins. I think that's very possible.
Again, for the listeners who want to better learn how to break down companies, can you explain sort of the Rule of 40 and more on margins more generally in terms of what we should be expecting?
Yeah. So the Rule of 40 is it's become, I'll say, a lot more important now that we're past the ZERP period where, in 2021, everyone just cared about it. Well, how fast was your revenue growing? That was the largest determinant of the valuation multiple that you get. The faster you would grow, the more you'd be worth. And so that behavior in a zero interest rate environment caused companies to spend more and more to grow, which hard to argue with that approach during that time period because that's how you were ascribed the highest valuation multiple. And if you want to deliver shareholder value, then that's what you had to do. Things couldn't be more different now. Investors not only care about top line growth, but also efficient growth. So Rule of 40 is a pretty standard methodology where all you do is take the sum of revenue growth or ARR growth with margin, whether that's, I've seen it done a few different ways. We take year over year ARR growth plus LTM, last 12 months, free cash flow margin. Because free cash flow margin can bounce around, we just take the last 12 months and we sum that up. And that is your Rule of 40 score. We also take NTM revenue growth, next 12 months revenue growth that the sell side estimates, as well as the next 12 months free cash flow margin, and sum that up as well. And that is the Rule of 40 score. Right now, I was looking at that before this call. Klaviyo has one of the highest Rule of 40s in the entire software index. They are I will tell you now, Klaviyo, as of last quarter, had a 55% Rule of 40. The highest company is CrowdStrike, which is at 65, and the median of all software businesses is 32. So Klaviyo is doing really well.
Yeah, that's a helpful review. Let's get to some of the risks that you identify in the in your piece. Or if you were to create the bear case, why would that be? Yeah.
Yeah, for sure. So I think logo growth was slowing down for Klaviyo. So at IPO, net customers were growing 24%. So customer growth tends to portend revenue growth at some level. Customer growth was slowing down for them. Why was that? Was that due to TAM constraints? Were they spending less money to acquire? Was it the economy? Not totally sure. So I think logo growth is something I continue to focus on. And I think just frankly, the obvious one around what we've been discussing, what is their path and how are they doing against new verticals, products, and segments? And what is the product roadmap against those segments? Still, less than 5% of revenue is outside their core e-com vertical. HubSpot has done incredibly well in SMB going multi-product. Can Klaviyo do the same? Can they get out of e-com? I think those are some of the biggest questions I have. And then, sales efficiency has trended down a bit the past few quarters. And so are they looking to maintain a certain high level growth rate while the cost to acquire is increasing and their unit economics are slightly degrading? Or is there something else going on? Not really sure. But I think it's related to logo growth. So can they continue to grow efficiently? And then I think the big question is just around what I mentioned around the float. What do the insiders do with their shares? Do they hold? And, can Klaviyo continue on the beat and raise cadence that best-in-class companies need to do to, get a little bit out of the penalty box, per se? Because if you look at their Rule of 40, they trade at a pretty low multiple relative to HubSpot. And so I think there's room for expansion, though, frankly. We'll just have to see the next few quarters how the company performs and what happens with the float.
Yeah. Okay, so we identified the risks. Why don't you further flesh out some of the bull case for why one could be excited at this point?
Yeah, I think they're objectively, if you include their market outside of ecom, it's one of the largest and most important software markets out there as we move more towards first-party data in marketing automation systems. They're also moving up market. Like I said, at IPO, their 50K ARR plus customers were growing 94% year over year. Their top 10 customers had an average implied ACV of around 900K. So it goes to show that they can land and make very large companies successful, and that segment is growing really fast. They are clearly a very product-focused company. The ease of use yet high configurability and power of the product shows up in the very quick time to value for customers, and this manifests itself in their incredible efficiency. And so you think about the business at IPO, it's a 700 million ARR business growing 55%, GAAP profitable with over 20% free cash flow margins, very strong net dollar retention, and they barely burned any money to get there. It's sort of like, with that fact alone, you're like, okay, I'm in. And then but I think there's some questions around what we described. And so if they can continue to execute on all those things, I think the questions about their TAM, about the float, about their verticals goes away. So I think they need to, if we see them executing on those things, which I think they can do, I think the the business will, they will see share price appreciation.
Is gearing towards closing here, is there anything from your piece from the S1 that we haven't got a chance to discuss yet, or anything else you want to leave our listeners about this business? Or
I think the only other thing is this is a company that had at IPO 36% of their revenue was outside the U.S., which is pretty unique. And because it was such a PLG driven company that a lot of companies are nowhere near that high. Although it's very clear Klaviyo, people have found the product from all over the world, and they find great value in it. And so it's just a testament that I think their market's probably even bigger than people realize. And so the same questions that investors are asking or questioning Klaviyo about today, how big really is your market, are probably the same ones that investors like me were asking when they did their first institutional round. And, the people who didn't, there were a lot of people who were wrong there. So I think you have a great team like Andrew and the cast that he's put together in a massive market. I think they're going to be successful.
Yeah. And a quick side question for listeners who may not be super familiar, Can you talk about the differences between sort of PLG-led companies and non-PLG companies, and particularly where that difference shows up in either the P&Ls or our expectations for how these companies sort of perform?
Yeah. So big topic all the time with private companies. Should we be PLG or should we be sales-led? I think the best companies have a combination of both. It turns out, and no surprise, the business model of using people to sell software at high margins is a very good model. And that will prove to continue to be the dominant model for the most successful businesses. You cannot show up to JP Morgan or GE or a G2K company and not have salespeople. It doesn't work. And so if you want to sell large contracts, you have to be sales. You have to have a sales assist sales-led motion, not even sales assist. And so I think PLG, product-led growth, means that people just go self-serve, sign up your product. That's a great model. I think, like I said, the best companies have combinations of these, but it all depends on your end market structure and your end product. Sometimes PLG makes a lot of sense. Sometimes it doesn't. Look at Zoom. I think almost every single one of their large customers started with a single Zoom license. And that is a viral, bottoms-up driven sale. Braze, a company that sells, a marketing automation solution to B2C large brands, it's not likely that the PLG motion is the CMO of Gap isn't going to go have their team try out a product and think about using it. So I think it depends on the company, the end market, your market structure. But bottom line, I think a combination generally of PLG and sales assist and sales led creates the best outcomes.
That's helpful review and great way to wrap, because we're at time. I just want to say that I've been reading your S1 breakdowns for years now, and we'll link to a bunch of them. I highly recommend
Awesome.
people checking them out if you're interested in this podcast. And Alex, thanks so much for coming on the podcast. We'll have to have you back in the future for a future breakdown as well.
Thanks for having me, Erik. Hope you have a great day. Take care.
Thanks for listening to Company Breakdowns. Make sure you're subscribed on Spotify, Apple, or YouTube. Let us know in the comments or reviews what companies you want us to deep dive on next. Company Breakdowns is a show from Turpentine, the network behind Moment of Zen, Turpentine VC, Turpentine Finance, and Request for Startups.